in just says that anything we say is general in nature. Any advice we provide will always be in writing to you, and that will be in the form of a statement of advice or a record of advice. So here we're just talking about general information. Okay, so Ryan, I might hand over to you for the virus and market update.
Excellent. Thanks for that, Chris. Let me just change screens here and we'll get this shared. Good morning, everyone. Thanks for joining us again. As Chris mentioned, I will start off by taking us through the Australian story, how we're tracking with our virus numbers and how we've been going over the last couple of weeks in particular. So I'll just bring up my screen here. Can we see that okay there, Chris?
Yep, that's good.
Excellent. Okay, well, the Australian story, if you've been following the webinar series, is actually quite positive compared with the rest of the world, where we did take firm action fairly early on compared to other countries. And our cases, as of last week, our cases were sitting at about the 7,000 level, and we just ticked over to 100 deaths when we did this session last week. But as we can see here from the graph of the long-term, I'll just move the pictures out of the way here. As we can see here on the graph, we had a spike like the rest of the world, but we brought our new case levels under control relatively quickly. And for the last 2 months, we'd really seen a slowdown in new cases. We'd really flattened that curve out quite well. The past week was going to be quite telling because the weekend before last was when we were just entering into the easing of restrictions around most states. And it was going to be a real test case to see, were we going to be able to keep our virus numbers under control? And over the past week, the news has been quite good. We've had 2 weekends now where things have been opened up a bit, the restrictions have eased off, and we've seen a continuation of those low new case levels. We haven't seen any kind of large spikes over the last week or two, which is very positive. We'll have to keep an eye on that as time goes by, of course. Time will tell if that continues as we go into further easing stages, but we in Australia here seem quite good at following the rules. We've eased quite sensibly, and yeah, we haven't seen a bad relapse in cases. Numbers haven't shot up too much. They've stayed on trend over the past 2 months, and we've only seen two extra fatalities since last Wednesday. We were at 100 last Wednesday. What's even probably more promising is not just that we're keeping the rates of infection under control, but the seriousness and the way we're dealing with serious cases is actually quite good here in Australia. On the last slide, we had 99 deaths out of about 102 deaths out of 7,000 cases. That's a 1.4% fatality rate for infected, and that's much better than a lot of countries all around the world, which really shows we're managing the situation quite well. Last week, when we looked at this particular slide, we saw that we had 12 serious cases in intensive care across the country and 45 hospitalized nationwide. Those numbers were a fair bit down from the start of the month. At the start of the month, we had 70 people hospitalized with the virus, and we had 28 people at the start of May in intensive care. That's come all the way down to 12 as of last week. And this week, we've seen that trend continue. So now we only have 33 people hospitalized nationwide with coronavirus, and only 5 in the most serious level of observation there in intensive care. So really positive numbers for Australia still. What's also very positive is our rate of testing. If we go back to the start of May, we'd had 650,000 total tests, as of last week, that had risen all the way up to 1.06 million. And then over the past week, we've had another couple of 100,000 people tested. So really strong commitment to testing. A lot of Australians have taken on the message from their governments to get along to the testing facilities, and let's try to make sure we're capturing a broad cross-section of the population so that we got what we have now is fairly high confidence that if there are cases out there, we've got a good chance of making sure we find them and control them early. And the numbers week in, week out are showing that Australia is doing very well at keeping things under control. So good news in terms of the Australian story. So as Chris mentioned, we're easing our restrictions. We've seen schools in New South Wales, public schools, go back full time as of this week, which was great for Chris, as you mentioned there, great for our family as well, as our 7-year-old and 4-year-old are now back at school and daycare, which is giving us a bit more of an opportunity to get back to a sense of normalcy, which is good. Pubs, clubs, restaurants, cafes, a broad range of businesses are starting to reopen, which is great. There's a lot of people out and about, still respecting the social distancing rules, but again, 2 weekends now, we've seen a good response to the reopening, and we haven't seen a spike in cases, which is very promising. Hopefully, we see that continue, as on the 1st of June, we see another round of easing of those conditions. Days since last reported case is always interesting to have a look at. Of course, New South Wales, Queensland and Victoria, the hardest hit states, we are seeing daily reports still, as we do have clusters within the communities. But a lot of the rest of Australia, Tasmania, WA, South Australia, ACT and Northern Territory, it's been quite some time since the last reported case in each of those areas, which is very promising to see. One of the things that's resulted in is some of these states have been a little bit reluctant to fully open their borders yet, given that they've had a lot of success in controlling their virus situation. They've had no new cases for quite a while. They don't quite want to open up their states to free travel just yet. And we are seeing different states taking a slightly different approach to how they're opening up businesses and their economies again, based on where their virus rates are. Well, the main message going forward is do the 3 to stay COVID free is what you'll hear a lot from the government over the next months as we open back up. Physical distancing, good hygiene, and the COVID Safe app are the 3 hallmarks to make sure that we keep Australia right at the head of the pack in terms of our virus management. Now, I think, Chris, you had a poll that...
I did. This is something new for us, and hopefully this works out okay. But I was actually interested to ask how everyone feels about downloading that COVID-19 app, because it has been quite a contentious issue, and some people haven't been at all interested in downloading the app. Other people have had no problems at all. So for the first time in one of our webinars, I thought I would ask the question. The question is, how do you feel about downloading the app? So you should have a little pop-up on your screen at the moment that gives you a chance to click how you feel about it, whether you've already downloaded it or you're comfortable, whether you're not sure and you haven't decided yet, or whether you absolutely don't want to, or if you've got no idea what we're talking about and you don't know what an app is. So the responses are coming through now. If you can find, or you can see that question, I'll just give that a couple more seconds. And oh, we're coming in now. So it looks like we've got most of the people have voted. I'm wondering whether there are any of our staff members that might have jumped in and might be voting as well. But I'll end the polling. So our results were that 67% of you were fine. You've either downloaded it or you will download it. A couple unsure, 14%, 19% not downloading it, and 5% wondering what an app is. That's interesting for me because I play a lot of sport, and I feel like the only way that they will open up sport again is for them to be confident that that COVID-19 has not spread through the community. And so for me, I'm actually comfortable downloading it. I also am highly aware that whenever I'm going anywhere, my phone tells me how long it's going to take me to get there before I've left, and I haven't put anything into a sat nav. So just Google seems to know exactly where I am and where I'm going, sometimes better than I do. So it's for me, I don't feel like it's a big deal. The biggest issue I have is remembering to make sure that it's turned on, but I'm not going out enough really for it to be a big issue. Okay, thanks everyone for participating in the app. I will just take the screen back from Ryan.
It seems to reflect the broader community there. There's been really good take up of the app and its use, and it is considered quite an important part of stopping the spread and making sure that people are getting tested if they are coming into close proximity with someone who has tested positive with the virus. So that's good.
Okay, so just very quickly, globally, Gil has showed this graph. It's something that he likes quite a bit. I guess you can see the flatlining countries. Of course, we question the data from China, but the new countries that are listed there are some of the emerging nations. So Mexico, India, Brazil, and even Russia. And what we're sort of seeing there is that they're becoming of interest as the virus starts to move around the world. So when we first started, so we one of the fund managers that we work with and their economists and their analysts started to produce something in March showing how the cases were growing. And at first it was really China, and then it actually towards the end of February, start of March, it became an issue with the rest of the world. And so this particular fund manager, Perpetual, started to develop these graphs. So I thought I'd just very quickly run through how it's changed. So about a week on, we realized that it had become an issue in Europe. So they were able to separate Europe to the rest of the world. And you can see here that Europe is the green color. Towards the end of that period, US started to be a bit of an issue, but at that time, President Trump was not really interested in dealing with it at all. We fast forward another week, and we can then see that the US has become quite an issue. And we've had a couple of phases here. We've had China, Europe, and the US. One of the things that you're noticing is that the bars are going up, but also the number on the left-hand side are going up. So from the 21st of April, if we fast forward a couple of weeks, you can start to see that Europe, it's starting to come under control with the green colors there. US is still being an issue, and it's starting to filter through the rest of the world as well. A couple of weeks further down the track, and what we can see is that Europe, again, is looking pretty good. US is still growing, but the rest of the world is growing. And if we fast forward again to the end of this month, we can see that it's started to filter out into the rest of the developing world. So I guess the reason that I want to highlight this is just to say that we don't necessarily, we're doing a great job in looking after the health outcome here in Australia. And it's slowly working through some of those bigger developed economies, which obviously has an impact on their markets. But it will also filter through some of the emerging markets, some of the developing countries. And that's the next phase. That's what we're seeing at the moment. So even though it feels like Australia has it under control and it's becoming under control in other parts of the world, this will still take a little while for us to work through it. But I don't want to spend too much time on that, just to highlight how it's changed over the last couple of months. Okay, Ryan, I'll hand back to you for the market update.
Excellent. Thanks for that, Chris. I'll just take the screen back. All right. There you go. How are we there, Chris?
Good, got it.
Excellent. All right, we'll bring that back up. So with the market perspective, as Chris said, different parts of the world are finding themselves in different phases of their virus journey. We thought it'd be interesting to look at what has happened in Australia compared to the rest of the world. Here we have the Australia's numbers and the US numbers in terms of how far did we fall during the worst of the crisis and where have we bounced back to now. Australia is pretty much, Australia fell in line with the rest of the world through the worst of our virus journey. We took action quite early. We were one of the countries which decided to lock down our economy a bit earlier. We knew that it would cause a bit more economic pain, but we were very interested in bringing our virus numbers under control and limiting our death rates, which we have done quite successfully with only 1.4% of our infected dying from the condition. What that has seen though is we have recovered a little bit slower compared to the world market overall, and definitely recovered less than the US to date. The US recovers quite well from these things, partly because they've got quite an optimistic share buying population. We saw from the global financial crisis, their market did recover quite quickly, a fair bit quicker than ours. But there's also other reasons the US has recovered a bit faster than us at the moment. And that's partly because they've got other sectors in their economy which have the opportunity to do quite well, even in times of crisis. So through the pandemic, for example, they've got fairly large tech sectors and biotechnology sectors, which have actually, their share prices have done quite well through this period as people use more technology to keep their businesses running, and the biotech companies are obviously putting in a lot of time and research to find a vaccine and also different ways of managing the virus. So that's helped their market bounce back a little bit faster than ours, where our markets are much more geared towards the global trade and commodity sector and also the banking and finance sector, which will take a little bit longer to recover. But we do still think that over the next year or two, we should still see our numbers recover quite well, even if it is a little bit slower, say, than the US. The biggest part of that story, though, is, as I've touched on and as Chris touched on, though, is Australia's willingness to close down our economy and keep it closed for a bit longer to try to control our death rates. Here we see we've only had 102 deaths for 7,000 coronavirus cases, where America, they were a little bit slower and a little bit more reluctant to sacrifice their economic activity. And that's resulted in a much higher rate of deaths. We're looking at about 6% of cases, about 5.8% of cases in America have turned out to be fatal, which is unfortunate, but it has meant a bit of a quicker recovery in their markets. As we like to do, we like to look at the last week in the Australian market and see give you a bit of an update on what's been happening. Things are actually looking quite positive, as you can see there. As we go back to the Monday before last, it was the first Monday after things opened back up, and we had our first weekend of restriction easing. And the market responded quite well the Monday before last to that, as we can see there. And last Tuesday, we had a very good bounce as there was some good early news out of America in terms of early vaccine testing, which was very positive. As the week wore on, there was a bit more caution returned, as we didn't quite get a continuation of new news. The market eased off a little bit, but then again, on the Monday just gone, after another weekend of eased restrictions, we got a lot of positive sentiment in the market. A lot of people felt good about where the economy was heading, that it was heading in the right direction. Businesses were coming back online. The shopping centres who had been hit particularly hard, there's a lot of confidence that they will start to see their situation improve as time goes by. And we got a pretty good lift on Monday. Yesterday, though, is probably the best trading session we've seen in about 8 to 11 weeks on our market. all that positivity from Monday continued into Tuesday, and we really saw those shopping centres, the retail stocks, which have been hit particularly hard, as Chris mentioned at the start, recover quite well. We saw 4 to 5% increases in some of those real estate stocks, like the large shopping centres. Part of the reason is, as Chris mentioned, early on in the pandemic, the shops were willing, the big shopping centres and the big retailers were willing to take a short-term hit to their profits by absorbing a lot of those rents that were no longer able to be paid as shops were not able to do business. They took a lenient approach to their tenants, which affected their bottom line and affected their share price. So when we saw the large falls at the start of the pandemic, we saw them fall particularly hard as people expected them to do things quite tough. As we're seeing a general turnaround in mood and people are starting to feel like the worst is hopefully, fingers crossed, behind us and things are starting to recover, people are starting to look at those real estate stocks again and think that potentially they've been sold down a little bit too far. And we saw investors come back and buy those quite heavily yesterday, which really gave our market a good boost. We saw the same thing happen with our banks, who also put on about 4 to 5% yesterday, which was great to see. And quite interestingly, some of our travel and tourism stocks like Webjet and some of the travel agencies were up around 9 or 10% yesterday, which really shows that investors are starting to get quite positive, quite optimistic that the worst is hopefully behind us. As we look at the 12-month story, we're now actually only down about 20% from our all-time highs that we saw in February, which is quite positive. We've seen the last couple of weeks have shown a good spike there. As we've seen over the past couple of weeks, you've heard the story before, but it doesn't hurt to look at where we are in the 12-month cycle. We obviously saw a large fall in the market through the worst of the crisis. As we hit late March, early April, as it was quite evident, our lockdown and restriction measures were working quite well and that we were ahead of the world in terms of our virus management. And as the government came out with quite strong, very large, unprecedented levels of stimulus, we saw a really good increase there through the early parts of April. As we hit mid to late April and the government was starting to talk about easing restrictions, the recovery slowed down because there was a bit of concern as to whether or not how that would look, what would happen, would there be a spike in cases? So a little bit of caution started to return to the market at that level, and we didn't see a continuation of quite such a strong recovery. But as we can see, things have still been cautiously optimistic over the last 2 months as the market has seen that the easing of restrictions both in Australia and around the world has really helped economic activity start to lift, which shows really good positive signs for a recovery over the next 12 to 24 months. And we haven't seen as big a spike in new cases as the market probably feared in about mid-April. So the long-term story at the moment seems to be a cautious optimism, which we'll hopefully see continue over the next month or two. And we'll keep an eye on that and we'll continue to talk about that as the weeks go by. We obviously don't expect to see these gains that we've seen over the last 2 days continue on indefinitely. There will be some setbacks, and of course, the news will love splashing that in front of everybody. But we do feel that those setbacks will just be part of a long-term recovery cycle. I'll finish off just having a bit of a look at this graph. This is an interesting graph which shows the levels of volatility in the market, how much it rises and falls on any particular day over time. As we saw back in 2007, 2008, there was huge levels of volatility in the market. There were increases and decreases of 5%, 7% per day. And we didn't really see that for quite a long time until the pandemic hit us about 2 months ago. And we started to see on the news movements of 5%, 7% day by day. That really has eased off. Here we can see that spike in volatility has really started to come back down, and we're not too far off long-term averages now. We're not seeing 5 to 7% movements on the market each day. we're seeing much more the 1 to 2% level and trending in an upward direction, which is a sign that the markets have settled from the initial panic and hopefully are on a bit more of a consistent, optimistic growth path. But time will tell as we see what happens with the virus. Hopefully, some of the research and that's going on out there might even push us along quicker on that growth path. Because if we do see a vaccine come into the market, or even if a lot of countries out there are not just researching vaccines, but they're researching ways of controlling and managing the virus. So even if we can't cure it, we can make it less of a big deal if you catch it. There's much better survival rates and management rates. If we see any of those drugs coming to the market and show to be quite effective, we could only expect an even faster recovery. But as I said, time will tell, and hopefully the positive news continues and we don't see a setback. Chris, I believe now you wanted to jump in and take a bit more focus on the dividend part of the market.
Yeah, absolutely. I guess the only thing I'd add there at the end, Ryan, is that graph is probably representative of demand for toilet paper. So there was that ridiculous spike. Now we're all fine. There's no problem.
Toilet paper's back on. Yeah, that's right. Absolutely.
Which is, I guess, comes back to the way that the share price is affected when there are people who are acting a long way away from being rational. So dividends. One of the things that really frustrates us is that when you watch the news at night, or when anyone reports on the performance of the share market, they talk about the price. And so if you're watching the news, you'll see that the All Ords or the ASX 200 got up to 7,000 and down to 4,800, and they give you these numbers. But what they never focus on are the dividends that the companies are paying. So there is actually an index that will tell you the total return, but the media doesn't tend to report on it. So seeing as we're kicking goals with these polls, I thought that I would ask ask a question about how big a percentage dividends play in the total return of shares. So as an example, if the shares gave you a total return of 10%, what part of that do you think would be dividends? So would it be less than 40% of the total return, i.e. 4% dividends and 6% growth? Would it be over 80%? Would it mostly be dividends? Or is it somewhere in the middle? So I will launch another poll. And hopefully this question doesn't have too much jargon in it, but really what I'm interested to know is what your impression is of the percentage or the amount of the total return that comes from dividends. And we're saying over the last 10 years. So it's either less than 40. So if it was a 10% return, then total return, then 4% would be dividends and 6% would be growth. It's between 40 and 80. Or it's over 80%, which would mean that of the total return, if 10% was the total return you got from the shares, then it would be 8% or more from dividends. So I'll give that a little bit longer. We've got about half the people who have voted so far. And I might leave it there and share the results with you. It's interesting that we've got the medium response has been the popular one. So I'll share the results with you, and the results are that most people thought it would be between 40 and 80%. 2 people thought it would be over 80%, and the remainder thought it would be less than 40%. So the results, those people who said that it was over 80% were correct. So in the last 10 years, the ASX 200 produced a total return of 7.1%. Now, obviously, if we looked at February, that would have been a lot higher, but that's taken into account March, which was the worst month in the last 30 years. The total return was 7.1%. Dividends and franking credits, so franking credits are those tax credits that are attached to the dividends, comprised 6.1% of that 7.1% return. So the price was up by 1% over that 10 years. So in the Australian share market, 87% of the total return came from dividends. And this is why we get so frustrated, because the media doesn't report on what's happening with dividends. They just report on the price. And it's really easy to look back and to see, well, hang on a minute, I remember that it got to 7,000, but it almost got to 7,000 before the GFC, didn't it? And then, you know, and it only just, it took 10 years to get back, 13 years to get back there again. And now we're down. Well, that's because we're not remembering the dividends. And one of the philosophies that we have is that any good investment should produce an income. If it doesn't, you're waiting for someone else to pay more than what you paid for it. So dividends are important. What happened last time with the global financial crisis? Again, I'm trying not to go into too much jargon here, but two graphs here. The darker coloured line is the share price. The lighter coloured line, and I hope it comes through okay for you, are the dividends. So what you can see is that if we do have periods of market crisis, so in this case, the global financial crisis here, I should have used my highlighter, then what we do see that that if there has been an economic crisis, that the dividends will reduce. The tough part is, of course, is knowing how much they're going to reduce and why, and is it a problem? So what we see here, this is to April, so it hasn't quite got the bounce back yet. But there is fully an expectation that those dividends will come down. So the question is, how much will they come down? And very early on in one of our first webinars, we talked about how we were expecting that we would see somewhere between 30 and 40% as a reduction in the earnings over the sort of 12-month period where the lockdown is in full swing. And so what should that mean for the share price? And at first, it overshot that amount, and now it's come back. But is there a way that we can get a bit of a best guess as to what's going to happen with those dividends? Well, there sort of is, and I don't want to go into too much detail here, but we're able to separate the companies on the share market based on how confident we can be that they will continue to pay dividends, that they will have a slight reduction in their dividends, or that they may actually pay none at all, and hold off on the dividends, or in some extreme cases, and Virgin is one of those cases, if they've got too much debt, they could be in trouble and go into liquidation. So we're able to separate the shares on the ASX, and here we're talking about the top 200, into a couple of different categories. And then, as Ryan was mentioning earlier, we separate the banks. And the reason we separate the banks is that that's a huge part of our share market. Our share market, the Australian share market, is heavily weighted towards financial stocks. The US share market is more heavily weighted towards technology stocks. So when you're thinking about Google and Amazon, and you're thinking about Apple, you think about these huge companies that are worldwide, they're technology companies. And as Ryan was mentioning, they've got the ability to continue at maybe not make more money. In some cases they will, but at least they can continue with minimal disruption, and their profits will stay the same. And so as a whole, that US market will tend to perform better in this sort of situation than what the Aussie market will. But we can separate those companies across those industries and have a bit of a guess as to what might happen. So if we go back to those categories, we say there's low, there's moderate, there's high, and then there's the banks. And we can have a bit of a shot at what they might do in terms of their dividend. So if we go back, we look at the percentage that they, the percentage of the stock market that they represent, the chance of the cut that they will have, then we can sort of add that up and say, look, here, as a best guess, it's possible that we will have dividends reducing by around about 40% for this year. And then for next year, that it's more likely to be around about the 24%. So where are we at the moment? The banks have already started to announce that their dividends are postponed or reduced. And that's not necessarily a problem, because that means that they've made the money. That money is sitting in their accounts. They've had that money for the last, up to 6 months, depending on when they last declared their dividend. So that's actually just a safety first approach. That's just saying, look, we've got the money, but we're going to hold on to it just in case things are not as rosy as what we hope they to be. And so that's actually a good thing. So we should be positive about that. Now, if your strategy relies on dividends from banks to provide you with your income, that's a different story. Now, that's not something that we've ever recommended to any of our clients. We've got a completely different approach, which I'm sure you would remember because we've discussed it most times on these webinars. But just because they're reducing their dividends at this stage does not mean it's a bad thing. But we do have to keep in mind that the market is currently down around 22% from its peak. So obviously, this number here is absolutely a best guess. And it's based on us trying to figure out when things will open up. We get good news, and this is why, as Ryan mentioned, the market bounced over the last couple of days. We had some good news. If it looks like we're going to do the right thing, this is going to be under control, and the economy can open back up, there's no reason that should be minus 40. That should be nowhere near that amount. But we do have to have, as Ryan mentioned, some cautious optimism because dividends will reduce. And one of the difficulties that we have is that we've worked through this pain. That month of March was the pain. But what we will have coming up is the media reporting on what results were in terms of economic activity and growth and dividends during that period. Now, we've already been through it, but that's not going to stop the media bringing it up, and that will have an impact. I don't think we'll go back to the same, the toilet paper effect, but it will have, it will play on people's minds.
Well, we have seen that a little bit already. There are some commentators out there, and the media is trying to say, what about all these bad numbers? There's still fairly high jobless rates expected. There's low growth rates. But to be honest, the market already knew that. When we saw the initial really bad drops during March, people already knew that things were going to be quite bad. So a lot of that was already priced into the original falls. Now we're seeing now that we're seeing the light at the end of the tunnel and the market's starting to increase, once all this bad news comes out, hopefully that won't put a damper on the market as it hasn't over the past week, because everyone already knew that anyway, and that's already been factored in.
Absolutely. Okay, and one thing to keep in mind, and there's lots of jargon on this slide, all those words, they're fantastic. There's two things this shows. One is the dividends that are coming from shares, that's the blue line, and orange is basically the cash rate. So the difference between the global financial crisis and now is that during the global financial crisis, if you were concerned about shares and about the volatility, then you could leave the share market and you could go into a term deposit and you could get yourself a 6% plus. And that was an option. That was if you were really worried about shares and you thought, no, this just isn't for me, you could go and get a decent return in cash, and it's a secure, guaranteed investment. And that's what some people did. The difference now is that, yes, dividends will reduce, no doubt. But when you look at the cash rate, when you look at the dividend, the term deposit rates at the moment, there will be a lot of people that will just say, no, I can't put my money away for 1%. Or if it stays in cash itself for 0.25 or even less. So there will be some support there for shares if the dividends don't reduce too far. And that was not the case, or not so much the case, during the global financial crisis, because the cash rates were a lot higher. There was an alternative that's available. So even though we're seeing dividends reduce, even though there still is the ability for us to have some of that sideways movement, there are enough reasons for us to be positive about the next few months, the next couple of years. And one of them is that a lot of people don't want to lock their money away at 1%. If they can, even if it's only 3% that they can get from shares in dividends, then they look at that and they say, well, it's a better time to invest than it was in February. Really easy thing to say. So there should be some support there for shares over the coming months and years. Okay, so where to from here? So the recent bounce has been fueled by liquidity. So all that means is that if the government throws a heap of money into the system, then you would fully expect it to bounce up. At first, that very first bounce, the month of April. So the month of March was the worst month on the markets in the last 30 years. The month of April was the best month on the markets in the last 30 years. Now, obviously, based on those graphs that we showed you, it didn't recover all the way up, but it's a great example of why you shouldn't be looking immediately to switch to cash, because you can miss out. Often the best periods come after the worst periods, and most people, if they are at the point of what we would call capitulation, where you say, right, that's it, I'm out of here, that happens when we have had the absolute worst of returns. So it's nice that that reward was there for you hanging in, and we wouldn't suggest that you do anything else. But that very first bounce back, it made it seem like it was a V-shaped recovery. The reality there is it probably just went down too far. What we would expect to see now is that we slow down, that volatility is reduced. So instead of us getting 5 or 7% in a day, it's 1 to 2%, and that's a good thing. What we would expect is that until we have a vaccine, and if we keep everything controlled, most sectors should reopen, but there'll be areas that will struggle. There'll be some areas that are unlikely to open up at all, and by that I mean international tourism and education. International students, that will also be an issue. But we would expect that if we can get everything under control, that at least we're able to continue as per normal within the country, and maybe New Zealand will really become one of our states, because I think that would be the only country we'd be able to travel to. The early signs seems that retail's bouncing strongly, which is good news for those property trusts, as we discussed. But as I mentioned earlier, that economic data will come out, and it will come out and it will seem terrible. But the share market already priced it in, exactly what Ryan mentioned. We had an interesting one from the government the other day. I don't know if you caught this, but we talked a lot about the plans that the government introduced to try and keep the economy going. And they had a $60 billion whoopsie-daisy, where they made the form a little bit confusing. And it turns out that half the people that could have qualified for the JobKeeper allowance were unable to receive a payment. So the government's in a position where they'd allocated, $120, $130 billion, and only half of it will actually be used. So at the moment, this becomes almost a political decision. They, of course, should give the money, because the whole idea is that they're stimulating the economy. But now they sort of feel like it's in their back pocket, and well, it's theirs now, and they don't know if they want to hand it over just yet. So that's going to be interesting to watch, to see what they do, because the whole point was to kickstart the economy and get it going. But we also had the announcement that, I guess, the NRL, I'm not sure if there's any rugby league supporters there, but a crisis occurred in NRL. It stopped. New guy came in, and they've changed some of the rules for the season. And they'll use this opportunity, or any organisation will, they'll use this opportunity to make changes that otherwise they might not have. And for the Liberal Party, that's going to be in relation to the workplace and industrial relations. So that's been flagged as an issue. Labor will not like it, but expect to see something coming out there where Scott Morrison will be trying to get changes through that he otherwise probably wouldn't have been able to, and he'll use this as the platform to do it. There'll also need to be a review of the support that's provided. That's here in Australia, and it's also in the US. I've actually spoken to some clients whose kids are working part-time and are actually better off receiving the job keeper allowance as well as doing their other part-time job than what they were before this happened. So there are some areas there, and this is more of a concern in the US because they don't have the same social support that we do here, and they don't like giving the money out to begin with. That's a philosophical issue there with the Republicans in control, and so there will be reviews that take place. And it may be possible that our government says, yeah, we said that you might get this money till September, but now we're going to cut it at the end of July. And they'll want to do that because they will have, or our country, our government will have a budget coming up in October. And the thought process very quickly shifts to how are we going to pay for this? And that's the reason that they're unsure about what they're going to do with that $60 billion, because that's not bad to have in the back pocket just in case it's needed, considering it's already been announced and they got the political benefit of that announcement. The other thing to keep in mind is that there's a US election coming up in November, and the tensions between US and China are still there, and in fact may even be heightened because of the virus. And we have a leader, I guess we'd call him that, Donald Trump, who wants to get re-elected. He made the COVID-19 issue a state problem. He said, you states can sort it out. It's not really for me to get involved with, because he wants to make sure that everything that he's doing is as positive as possible so that he can get re-elected. So it's quite possible that he will escalate things as we come up to their November election so that he can get re-elected. And that is generally not good news for the share market. But I also believe that one of the things that he does is he uses Twitter to to influence what's happening. And if he feels like it's in his best interest to say something that's positive to get a lift in the share market so that he can claim that he helps the share market, then he'll absolutely do that. So it's possible that that we could still be in for a period of volatility just yet. So all of that, lots of positives, lots of negatives. We feel like cautious optimism is required. We would love to see a V-shaped recovery, but that's highly unlikely. And what we would expect is, we say a U or a V. Look, we're trying too hard with these letters. I think we're going to bounce around for a little while, and then a bit up and a bit down, and then hopefully as we get better news coming through, as the country starts to open back up, then we won't be back to 100% because those areas like international travel and international education, that's going to be an issue for a little while till we get the vaccine. But obviously hopeful that over the next few months we continue to go up. But it wouldn't be a surprise at all if we had another 5 or even 10% drop, only to have that bounce back later on in the year.
Yeah, that's definitely possible. I think we had a question in chat there, Chris, which might relate a little bit to that.
Mm-hmm.
Bring that up. Is given the lower returns expected in the market over the next over the short term, how does that reflect in the economic story? And there's just still a lot of uncertainty out there generally, and when there's uncertainty, there will be large rises and pullbacks in the market as time goes by. So the market can move quite ahead of underlying economic activity. We expect economic activity to recover, hopefully, based on what we see at the moment, over the next 12 to 24 months. So 24 months is what is kind of the end of next year, is when a lot of central banks are predicting we'll see a return to normal economic levels. The market doesn't need us to get all the way back to those levels, though, to start pushing ahead. As long as they can see light at the end of the tunnel, it should move ahead of the underlying economy. But again, there's a lot of unknowns if we find that there's faster progress in terms of vaccines and treatments, we could see things, both the market and the underlying economy, recover much quicker than expected. But if things go a bit slower than planned, if we do see a little bit of a setback in terms of virus numbers, we could see things flatter for a bit longer. So as you say, we're cautiously optimistic for a U-shape at the moment. The government has sort of set expectations quite low in terms of what they think economic activity is going to be like. But then over the last couple of weeks, we've started to hear a bit more of a positive message as things have started to open up. Maybe job figures won't stay as low for as long as expected, and that might see the share market recover a little bit ahead of the underlying economy generally.
Okay. So just a couple of other points before we finish up. Some of you will hold investments, super funds, pensions with Colonial First State. So you may have received some information about the sale. So at the moment, Colonial First State is owned by the Commonwealth Bank, and the Commonwealth Bank has sold 55% to a private equity company. So for those of you who have received that letter, we will have something coming out in the next day or so with a bit more detail. But we see that as a positive. Commonwealth Bank has been looking to. Colonial First State is one of the industry leaders, and that's the reason a number of you have accounts with Colonial First State. They are in the top 2 investment platforms, we would call them, that are available and they have a great range of investments with relatively low fees. So a lot of our clients have accounts with them. It's very successful, and Commonwealth Bank has been wanting to actually separate it and have it listed in its own right. So it's actually doing so well that they feel like they need to slice it away from the Commonwealth Bank itself and it be listed on the share market as its own company with its own CEO, its own board, the whole lot. Now, one of the things that's happened is that that was actually in the pipeline for about 18 months. One of the things that's happened is COVID-19. So they've got their heads elsewhere. So what they've basically done is they've got in contact with this private equity firm, which is a company in the US that has more billions than you could imagine. And they've sold half the business to them. What I would expect, given that Commonwealth was planning on spinning off Colonial First State to be its own listed company, I would expect that they've gone in and they've got this private equity company to do all the work for them. So they basically said, look, we'll sell you part of it. This is what I think. This is an opinion. This hasn't come out. But they've said, we'll sell you half. You do all the work to get it listed. And then we'll hold on to the other half. And then when it's listed, we all get our money. So the good news is that this private equity firm has very deep pockets. And before they list a company, what they do is they make sure that it is absolutely running superbly. So what we would expect is that there would be a fairly significant investment in the future. Colonial First State has already reduced its fees in the last 12 months, so it's unlikely to do that again. But what we would expect is that they will be trying to invest in the company to really give it a strong competitive advantage so that when it goes onto the share market, people want to buy the shares. So if you do have a Colonial First Day investment, you may have received a letter. We'll send something out over the next couple of days, but we see it as a good thing. So it's not something that you should be concerned about at all. Okay, and the last thing I mentioned very early on, so for those who arrived into the session a little bit later, we are after some feedback. So we have a link to a survey which was in the invitation that we emailed out yesterday. We would greatly appreciate if you could fill it in. Up until yesterday when I sent that out, we did receive some feedback which was very positive. We assumed that soon as people continue to tune in, that there's some value that we're providing. That feedback that has come in, the first few people who responded, was very positive, so we appreciate that. And of course, if you're finding it to be of value, we'll continue to provide these sessions. I think that the most likely outcome is that we'll continue weekly for a little while yet, but then we'll probably drop back to fortnightly. But based on the feedback that's come through, we are likely, even once we're through all of this, we're likely to continue monthly webinars just to keep everyone in touch if it's outside of their normal review cycle. So if you can, we would really appreciate your feedback. There is a link that is on the invitation that was sent out yesterday. And we'll have a draw for a small gift in the next couple of weeks, just as a thank you. It's something that we're happy to continue doing as long as you're happy to continue tuning in.
One of our viewers there, Chris, just mentioned that they didn't receive the email and link yesterday, so I've taken that down and we'll make sure we send that out to you.
Thanks, Ryan. Okay, so any questions? I think you've been dealing with them as we've been going, Ryan. You've sort of seen them come up.
I hope I covered off on that first question. I thought I'd jump in just while we were talking about economic activity and impact on the market. The general message being that they don't always work in sync. The market tends to work a little bit in advance. It tries to predict and work in advance of underlying economic activity. So yeah, economic activities probably take a little while longer than, say, the markets to recover. But the markets work not just on the underlying numbers, but there's a lot of, say, fear and optimism. So you see a lot more ups and downs than, say, what available information would justify a lot of the time. So we've seen a lot of positivity over the last week. As you said, Chris, it wouldn't be surprising if we did see a 5 to 10% drop before seeing things continue to increase, as long as the news stays relatively positive.
Okay, thank you very much, everyone, for tuning in. If Gil's back next week, I'm sure he'll be here in the chair. He loves these sessions, so thanks for bearing with us while he's taking a short break, and we look forward to talking to you in the future.
Thank you very much.
Thanks very much.
Bye-bye.